Hello, it is the 15th of January 2011, and welcome to today's Silver Log. And if you have not entered the Silver giveaway, you have until Sunday, the 16th at 6 p.m. Eastern to get your high, low, and close value in. And we're going to start off with this weekly chart now. And since this move in here, we had this downsized candle, and then this one in here, a less volatile candle, but on a red tick. And what this has meant is that we have had some sort of correction. This correction has no signs of being over. And if it can at least hold this 28 level, then it will be that of a time correction, even though the market is down close to 10% from its highs. So 28's a big level. And going below that, we've already talked about the Fibonacci 26, 25 area. That would be the expected area. And in fact, in order for the market to stay bullish, it would have to really hold that area. In order for the market to stay super bullish, it has to hold 28. So far on this long-term time frame, we are still extremely bullish, but we have to continue to hold 28. Now, as far as where we may potentially go, I have drawn in a couple potential scenarios. And I shouldn't say potential, I should say possible, because, well, this next one's not that probable, and that's a market crash. If something like this were to happen, where we follow next week with this down move right in here, and then a time consolidation, then boom, a big market crash. What would people be saying? They'll be saying, oh, it's manipulation. JP Morgan is doing all of these tricks. It's a paper market. And well, you know what? Those people are going to be right. So I'm going to say it now in advance before it happens, if it does happen, that if anything like this goes on, it's because of the paper contracts. And it sucks if you hold the physical bullion. And I guess it would be amazing if you want to buy it. And I say guess because good luck getting decent prices if something like this were to occur. Because if any type of major fall happens, it would be most likely anticipated that the premiums would go higher. And another potential case would be the market to be going higher. We hold 28 in here, the 28 level holds, and then we have a nice candle, and boom, two uptick candles here. Well, the same thing would be the case based on the moves lower. It is the paper contracts that would be making these prices go towards the upside. In fact, this whole gain here is because of these paper contracts. So we realize that silver traded at $1.29 throughout the 18th and 19th century, at least according to Kitco.com. That kind of makes you wonder what the value of silver should be when we realize that the dollar has lost well more than 99% probable. Most likely, these stats, no one knows exactly what these stats are, especially when a lot of the data given is a little bit not correct, if you will. And that can give you an idea of what the silver price would be. And overall, when it's all said and done, it's going to be the free market that will ultimately decide where the price would go. Because a lot of people are holding on to the silver, at least myself, because they realize how our dollar is created. And when you realize that, you buy the physical silver, not the COMEX prices, not the SLV, but actual bullion silver rounds and silver bars and silver spoons and scrap silver quarters and dimes and all that kind of stuff, because they realize that when people lose faith in a currency backed by pretty much nothing, And that's the reason why they do it, because they realize the value will continue to hold. Well, moving on to the paper market and the 15-minute time frame. And the 5-day moving average here has been tested. The 5-day moving average has not been touched up until now since the August breakout. And it went below it, and it's now holding this level. Now, the probability odds when you have a major rising 50-day moving average like we have had, and you finally touch it, and you're in this type of a trend that we at least have some sort of bounce, is fairly good. Now, what would be a little concerning is if we have a bounce, maybe up to the 29 to 30 level, and then when it comes back lower, that could potentially give reason for the 50-day to give in, and then the test down towards the 25, 26 level. Now on here, I have this thing called column C. And what this is the volume weighted average price since the market broke out back in August. And it's below 27 and thus not on this chart. But at some point, if this 50-day moving average does give in, that would be the next average as well as the 100 and 200-day moving average. For this video, I'm not going to show the 100, 200, but most likely if we break the 28, you'll be seeing it sometime next week. And as long as this 28 level holds, like I'm saying, that's going to be extremely bullish for this market, because that is where the 23.6% Fibonacci level is from the August breakout and the current January highs. Now, moving on to these indicators that I was showing before, the direction from the 50-day low. Now, what's happening is what I want to happen, and that is for this to get to at least around this 10% area, meaning 10% from the low, because what I would rather have is the bias of this chart to say time to go long when it's at a lower level. For example, if the breakout is above this 30% range, I'm really not a big fan of it. And I say this because I like it to have a decent retracement. This is showing us that we are having that. And when this starts to show a pattern where it can establish a higher high, a higher low, and look to break out, the direction would state that silver would be a decent buy and should have a nice push higher. Right now, that is not the case. The rate of ascent for the 50-day moving average is no longer as big as it was before. It is still rising. As long as it's above this level here, or above the zero, then it is a rising 50-day moving average. But it's not rising as much as it was before. And this line now, it's below the 0%, which means it is barely below the 50-day moving average, and the keyword is barely. It pretty much is at that level. And I've mentioned before that we've had this trend line break of the key levels, and now the question is this going to be a reversal? The reversal would mean that we at least test towards this 26 level. Is this going to be a bear trap, which means that we go below this level and then sometime over the next few days it recaptures this trend line, breaks above it, and if that's the case, that this would be a failed move. The fast move would most likely go towards the upside, and this could even mean that we just correct through time, because a break of an uptrend line can mean that the rate of ascent has been slowing down, and that's been shown with that rate of ascent descent declining within the 50-day moving average. So I'm going to thank you for watching this video, and have yourself a magnificent weekend, everyone. Bye-bye.